Greetings, everybody. Welcome to Liberty Call. Today is Wednesday, June 28th, 2023. Hope everybody's having a fantastical day out there. It's another beautiful day here in Colorado. Wish you were here. I am Raymond Dahlman, your humble host here at the Liberty Call, and hope you're having a wonderful day. My wonderful assistant Jake is sitting under my chair, so if you see him wandering around, don't get surprised. So, anyways, kind of another meh day in the markets. Most of them were red most of the day. Most of the Dow, the SP, and the Nasdaq, and came roaring back here at the end of the day. So, again, I think people are trying to get a sense of direction on where the markets are headed after last week's Fed meeting. There was a lot of hope that the Fed was going to cease their interest rate hikes. That was the hope across, I imagine, most of the big traders and institutional folks out there. But Chairman Powell's not following the script that they'd like him to play. So, anyways, all right. Well, if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. Please give me some thumbs up, likes, shares, subscribes, follows, all the good stuff. And let's go ahead and jump into the numbers for today. Dow Jones looks like it finished the day down 0.22%, 74 points, closed at 33,852. The SP 500 looks like it's going to finish up flat, closing at 4378. NASDAQ barely up 0.27%, closed at 13,591. The VIX was down 2.4% today at 1341. Canada was up 0.43%, Brazil down 0.76%, and Mexico down 0.87%. Lots of green across Europe. Germany was up 0.64%, the UK up 0.52%, France up 0.98%, Netherlands up 0.95%. See here. Spain up 0.94%, Italy up 0.86%, Switzerland up 0.37%, and Portugal up 0.36%. Russian exchanges were split today. The MOEX up 0.15%, the RTSI down 1.32%. And the overnights in Asia, the Nikkei in Japan was up 2.02%. Australia was up 1.1%. New Zealand was up 0.9%. In China, the Shanghai was flat at down 0.01%. The Shenzhen Component down 0.47%. China A50 up 0.36%. DJ Shanghai flat at up 0.03%. Hang Seng up 0.12%. And the Taiwan weighted up 0.28% for the day. All right. So kind of a mixed day, like I said. Looks like Europe was in a good mood, but here domestically, not quite so much. All right, well, let's jump into today's market recap. SP 500 and Dow decline with continuation of Fed hikes in focus. On Wednesday, the SP 500 and the Dow traded lower following remarks from the Federal Reserve Chair Jerome Powell, indicating the likelihood of further interest rate hikes. Powell stated that he did not expect inflation to reach the central bank's target rate of 2% in the near future. The prospect of continued rate hikes led the concerns among investors and contributed to market declines. Market participants reacted to Powell's comments, with Phil Blancato, CEO of Landenberg Asset Management, acknowledging that the Fed may not be finished with its rate hiking cycle and that inflation remains too strong. He noted that the market must accept the Fed's intentions, agreeing with Powell's stance. Additionally, seasonal trends ahead of the U.S. Independence Day holiday and the desire for a breather after strong growth in the first half of the year contributed to the market's decline. However, certain technology stocks experienced gains, with Apple, Tesla, and Microsoft and Alphabet being among the S&P's top contributors. Michael Green, a portfolio manager at Simplify Asset Management, highlighted the market's focus on the technology sector, particularly the AI sector, which has significantly increased valuations compared to other market segments. Despite the overall market decline, the Wall Street Journal's report on potential export restrictions of AI chips to China impacted chipmaker NVIDIA, which initially experienced sharp losses but later recovered. Investors are closely watching upcoming economic indicators such as the Personal Consumption Expenditures Index, initial jobless claims data, and the final reading of first quarter GDP to assess the state of the U.S. economy. These data points, along with the Federal Reserve's annual stress test results, will provide further insights into the financial sector's capital requirements and potential stock buybacks and dividends. Netflix saw a 3.9% increase after Oppenheimer raised its price target, while General Mills slid 4.7% as the packaged food maker provided a full-year profit forecast below analyst expectations. Overall, advancing issues slightly outnumbered declining ones, with the S&P 500 and NASDAQ Composite recording new 52-week highs and lows. Traders are now anticipating a 25 basis point interest rate hike in July, with expectations of the Federal Reserve keeping rates steady through the end of 23. All right, so that's what's going on today in the markets. Let's dive a little deeper into some not so good news. Interest on the national debt poised to rise at an alarming rate. This comes from Zero Hedge and via shiftgold.com. All right, let's see what they have to say. Since the resolution of the new debt ceiling issue on June 2nd, the U.S. Treasury has borrowed an additional $700 billion, pushing the national debt over $32 trillion. The surge in borrowing was expected as the Treasury had been nearing its borrowing limit for nearly 6 months. However, the problem lies not just in the increased debt, but also in the rising interest rates associated with it. Interest on the national debt has been rapidly increasing. In May, the trailing 12-month interest on the debt reached nearly $600 billion, up from $350 billion in early 22. This means the government is adding an additional $250 billion to its annual expenses solely for debt service. The situation is expected to worsen as the Treasury needs to replace low-yielding debt with higher-yielding bills, notes, and bonds. The recent Treasury sale in June revealed the extent of the problem, with short-term Treasury bills offering high yields. As a result, the share of short-term paper supporting the debt is approaching its upper limit, and the Treasury will soon have to issue longer-term notes and bonds at higher interest rates. The question arises as to who will buy all this debt, considering that major buyers like foreign investors and U.S. banks have been reducing their holdings. The federal government has also been unloading Treasury securities as part of its monetary policy tightening. The increased supply of Treasury securities combined with falling demand could create a demand vacuum, potentially leading to higher yields for longer maturity securities. If interest rates continue to rise and remain elevated, interest expenses could rapidly climb and become one of the top 3 federal expenses. This situation raises doubts about the Fed's ability to continue its fight against inflation. It may be forced to cut rates to keep the government solvent and resort to quantitative easing to artificially boost demand for Treasury securities. Overall, the U.S. government's increasing debt and rising interest rates associated with it pose a significant challenge with potential implications for the economy and monetary policy decisions. Yes, it could be so unsustainable that the government goes boobs up and the fish will be bobbing on the surface. So I am not real enthusiastic about the way things are being handled in Washington and with the Fed. We should be paying off debt right now. I mean, there's plenty of revenue coming in through the Treasury. We should be, sequestering a third of it or half of it to pay down the debt, and just slash and burn, all these federal programs that truly are not necessary. We probably don't need to spend $1 trillion a year, making enemies on the other side of the globe. I don't know. That's just my thought. I am a veteran. I did serve this country for 4 years, so my opinion does count a little bit. All right, last up comes from Mises Wire. It's titled "The MMT-and-Bailey Fallacy," written by Rudolph Cohn. All right. Let's dive into this. The author criticizes the ideas put forth by the modern monetary theory advocates, particularly their claim that sovereign governments can never go bankrupt because they can always print more money. He refers to this as the MMT-and-Bailey fallacy, where the mot is the technically true notion that governments can't go bankrupt, and the Bailey is the idea that printing more money doesn't lead to societal destruction. Cohn argues that when governments print money to buy goods, it disrupts the expected flow of goods and can lead to the collapse of long-term projects. The marginal projects become unfeasible, resulting in wasted resources. While the government benefits from the new money by attracting cronies who seek lucrative contracts, the overall impact on the economy is detrimental. He cites universal health care as an example, noting that the amount of new money required to provide it would be a significant fraction of the total money in circulation. The removal of incentives to conserve resources would lead to rapidly escalating healthcare costs, and the diversion of resources from productive endeavors. Additionally, Cohn highlights the inefficiency that government-run healthcare systems often face. To address the price inflation caused by excessive money printing, the government would need to raise taxes to extraordinary levels, potentially reaching 50%, 75%, or even 90%. The author accuses MMT advocates of ignoring and downplaying the negative consequences of unrestricted funding for political pet projects. They view these advocates as court intellectuals serving the politicians' interests and warn of potential collateral damage resulting from their money printing schemes. Ultimately, Mr. Cohn suggests that if politicians embrace MMT, the advocates themselves will eventually face failures and be relegated to jesters. However, the author expresses concern about the devastating consequences that would follow their monetary policies. All right, so basically MMT is just moving the decimal point around in the monetary system, and poof, more money is there. The problem is that it then creates distortions in the supply chains and the commodities markets, and just screws up everything from your electric bill to putting gas in your car to the food that you buy, because energy affects every single aspect of our lives. And then it just funnels through the economy, and that's why I brought up in recent meetings with clients that energy inflation has finally gone into the red. Which, how long is that going to take to get out to you and me and the general public? And it took a year or so for all that money spending back in 2020 to start affecting our bottom lines in late 21 and then all of 22. So I'd say probably a year would be my best guess, assuming that other crazy things don't happen, and we can keep the Federal Reserve and the federal government from monkeying with the economy. Just let it happen. Let's go through this downward cycle and come out the other side. And hopefully, we'll then have the better part of a decade in front of us of smaller problems, hopefully. So, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.